financial solutions, and over time to drive the cost of those solutions down to a scalable level. And I think there's an inherent conflict between that dynamic in the traditional financial markets and some of the things that this panel have identified as the objectives of impact investing or value-centric investing. So I think there's a tension at work that I think will be interesting to see 5 years from now. But I think the financial market tends to neutralize the distinctive elements of solutions to package them in a way that can result in an efficient price. So,
but the only other thing I would, on a positive side,
thank you.
One, there's a proliferation of funds that are coming out trying to address these questions, and you know, Michael and Watershed are kind of intermediating some of that now. But if you go to the Global Impact Investing Network, the GIN, not the tonic, so the GIN website, they have a list, and they've compiled a large number of available funds, existing funds, closed, open. They do it by category, they do it by location. It's a pretty impressive list of what's out there. Yeah. So it's not a, those of us in it, it feels like a groundswell. Yeah. In reality, it's, you know, it's up a couple of, the water level's up a couple of centimeters. But as more people, you know, CalPERS, CalSTRS, they have actually allocated some money to that. I think they've had some mixed results. But as more people try it, as effective investments take place, there will be increasing demands. And to come back to this, I think it's the family offices, it's the high net worth individuals who will drive it. Banks are essentially conservative. This is a risk-taking venture, not a lot of value in taking a risk within a large institution. So it's you need to find those idiosyncratic people who are willing to take that risk, to push it forward. How successful will that be? Will it take 5 years? Will it take 10 years? It took 30 years for microfinance to become an accepted investment and the best defined of the investment classes. We're in that process. Where will it end up? Hard to say. How quickly? I think it's an inevitable piece of the dialogue of investment, especially by socially conscious investors.
Well, you clearly see a significant increase in the G3 interest in this. Some interest at the G2 and very little interest at the G1 level. And financial institutions will follow the demand. So whether it's 5 years, 10 years, 15 years. And one thing that's interesting is that the more clients I've been speaking with, I met with one yesterday, who is interested in the Bill and Melinda Gates Foundation model. And I think that is an example that has made a significant impact and will make an even more significant impact on the way people will be giving in the future. So I would expect to see it become more significant, and it's a question of whether the banks can follow it, or the financial institutions can model it and commoditize it.
I think you had a question?
No, I just felt needed to speak up on JP Morgan's behalf, given I'm from JP Morgan. But no, I actually did have a question around this topic, though. I think one of the reasons for I agree with many of the comments. But one of the reasons I think, in addition to the, I work in the private bank with a lot of our big foundation clients and foundations who speak up, who want to leave a legacy with what they're doing, and they naturally look to business and space. That's certainly one reason for establishing, this comes out of our social finance group. But I think the second reason is looking to create, this metric system to try and evaluate some of the social returns and impact, in addition to the data around the financial results across the various asset classes within this overall umbrella of social impact investing, partnering with groups like GIN and the Rockdale Foundation, et cetera. And I think the reason for wanting to do that is because in order to really get this off the ground, they see institutional money, right, is really what drives a lot of the emergence of various asset classes. And we've been talking about the fact that this is not necessarily something that can be commoditized. In your view, recognizing that, I'd be just curious if anyone has any thoughts about,
short answer, I think, is yes. The only question is when, because you have Tufts University with a $100 million microfinance fund. Once they get enough time and experience, and if it's a positive result, there'll be other endowments interested in that. What?
They're already doing it in Europe.
They're doing it in, yeah. To Genia's point, they're doing it in Europe. So it's taking place elsewhere, and there have been some groups starting that. Impact is still hard. I mean, even the impact that from the Gray Matters Capital, it's a little obtuse to me. And how do you actually aggregate that, and how much time and energy do you want to spend on aggregating? And it is open to criticism as to whether you've captured the right things. It still hasn't happened. I think the Gears and IRIS sections are actually quite good. And to add to your testimonial on J.P. Morgan, I was really impressed when it was first the social sector group was set up and put as part of the investment bank. And I think it's migrating a little bit, but to have it embedded in
my thoughts. Steve is heavily focused on pension funds and big foundations. I see it as more of a bottom up. It's the small family foundations that are the ones that are, they're more risk apt. They're able to take more risk. It's not the investment committee is mom, dad, and the kids, as opposed to a bunch of people have their butts on the line and are going to lose a job if they make a decision that the masses don't support. Dennis, what I'd like to hear from you, I've read a few articles on fiduciary responsibility in a foundation, and when the IRS says, okay, these assets are for the to be used for the public good, I would say that it would actually be too risky. Owning Monsanto and in a foundation, I think, is very risky. Owning Exxon in a foundation, unless you're doing share owner advocacy, is very risky. And so, I'd be interested to hear your opinion on that. Where I think there's two different risks.
Well, first, I think you've got to put this.
I think you've got to stratify the foundations you're talking about. I think the private foundations with the family involved will move very quickly in this area. I mean, I've got one group now that's looking strictly at green investments. And that group, and what you have to look at is who's going to complain. Who's going to complain? In that family, there are 3 potential complainers. The board of directors, which the family controls, the attorney general, which is very lax in most states unless somebody steps forward, and the Internal Revenue Service. So as long as you avoid the jeopardizing investment, you can get around that. Once you get into the larger foundations, it's been my experience that you've got the investment committee, and they are responsible for seeing that the rate of return is comparable to what the benchmarks are. They report back to the board. If they're not meeting the benchmarks, the questions come up. Then you've got the grant-making group that will do the grant. And until those two groups get together, it's going to be very difficult to judge one against the other. In other words, if I'm on the investment committee and I'm chair an investment committee of a group, and we had this very question put to us, and I said, you look at our mission, and our mission is to support this particular school. We believe that by maximizing the investment return, we're supporting the school. If the school wants to make grants, they can do that. So until that governance issue gets straight, it is extremely difficult to meld those two. And that's where you go back to Steve's point that the law, the governance, and society have not caught up with it yet. So that's why I agree with you that it's going to be a bottoms-up approach.
Okay, we're going to wrap this up. One more question, and then we're going to vacate the stage and let the next group come up. So.
Sam, you had talked about a wide range of investments from the app in Bangladesh to rent Europe. How do you see, and this is really for anybody on the panel, how do you see the definition of what gets categorized as an impact investment changing? Or has it changed over the last 5 to 10 years? And what do you see happening over the next 5 to 10 years?
Well, as a short part of it is, when we were investing, the question was embedded was, is social impact an important part of their business plan, of the companies we're investing in? And how did they define it? Is it reaching out? How many people? How many houses? How many applications? Cell Bazaar, for example, I'll tell you, while they came out kind of looking towards connecting farmers in Bangladesh to the market price, it actually became Craigslist. I looked one this morning, and there was, in addition to a pot of fish for sale for 230 to 280 taka, there was a Honda motorcycle for sale on it as well. Those are the two highlighted deals of the day. And so it migrated. So it's hard to tell what the initial idea was to what it becomes. But to the extent, and D-Light, the lantern is actually a great one. They're selling it for $10. They're selling it in the developing world. They're replacing kerosene. They're trying to get to 50 million people. And that is clearly, because of where they're selling and how they're selling it, that has that impact. A long way around that is I think that you look at those businesses, you look at those funds, how are they talking about what they're doing, and how are they, and does it pass the smell test the first time? And as you dig in and ask questions, does it continue to be part of their ethics as they go through?
The only thing I would add to that is that in our client base, I think there's a shift in some respects away from talking about impact investments to a different discussion, which I think Steve may have alluded to, Stephen, earlier, and that is the approach that this is a fund of assets within our family, in our context, that is dedicated to accomplishing some goal or purpose. And how do we harness that whole fund of assets to better accomplish that purpose? And one of the most striking examples of the outcome of that conversation is people starting to spin down their foundations that were created as perpetual foundations, because they're harnessing those assets not just as investments or grants, but as a fund of resources to accomplish a purpose. And to me, that's a shift. It's a way from investments to what is the purpose of this reservoir of financial assets, and how we put them to work better to accomplish that purpose. So I think that's a shift as well. So thank you. We'll all be around if you want to talk.